For what, 70, 80 years now, the whole global financial system has sort of hummed along based on one big idea. The US dollar is king, rock solid, ever since Bretton Woods back in 1944, right? But something's shifting. You can feel it. It's not loud, but that foundation, it seems to be cracking. So today we're going to look closely at what's happening. We're tracking this challenge to the dollar, why everyone seems to be turning back to gold, and crucially, how recent U.S. policies are playing out right here at home.
And this isn't just academic, it's not just charts on a screen. We're talking about a potential shift in global power. It affects everything. Stability, jobs, what things cost, the debt we're leaving behind. It's significant.
This move away from the dollar de-dollarization, they call it, is it really measurable or is it more hype?
Oh, it's measurable. Very much so. Look at the first half of this year, 2025. The dollar index dropped 11%. That's the worst it's been since the oil shock back in '73.
11%? Wow, that's not noise, that's a signal.
It's a definite signal. It shows wavering confidence, not just in the currency, but maybe in the U.S. economy itself.
And it's not just market sentiment driving this, right? Governments are acting. We're hearing about countries like India, Brazil. They're actively selling U.S. treasuries.
Yes, at a pace we haven't really seen before. They're deliberately reducing their exposure to the dollar, shedding those bonds.
Why? I mean, why the sudden urgency? Was there a tipping point?
Well, if you connect the dots, a lot of analysts point back to 2022. Remember when Western nations froze Russia's foreign reserves?
Of course. A major economic weapon.
Exactly. But it sent a, shall we say, unintended message to the rest of the world.
Which was?
The message was, your dollar reserves. They aren't purely economic assets, they're political tools. If you fall out of favor with Washington, poof, they could disappear overnight, or at least become inaccessible.
So the perceived neutrality of the dollar system was shattered.
For many governments, yes. That was kind of the last straw. It showed the system wasn't as reliable or apolitical as they'd assumed.
Okay, so if central banks are getting nervous about the dollar, politically and economically, where does that money go? Where's the safe harbor now?
Well, increasingly it's going back to something very old school. Physical gold.
Old. Really?
Absolutely. Look at the trend over just the last 5 years. The share of global reserves held in gold. It's doubled from under 10% to over 20%.
20%. And you think it could actually overtake U.S. Treasuries?
The projections suggest it's heading that way, yeah. Which would be a massive reversal, historically speaking. A huge change in how countries store their wealth.
And the market price reflects this rush to gold, presumably. We keep hearing about record highs.
It does. Gold prices surged, 43% in the last year alone, trading around $2,300 an ounce recently.
Wow.
And crucially, this isn't just, small-time investors speculating. This is driven by central banks. They're looking for an asset that's, neutral, something that doesn't depend on one country's promises or political wins. Gold fits that bill.
Okay, so globally, there's this shift towards gold, driven by a loss of confidence in the dollar. Let's pivot back home then. How are U.S. domestic policies, particularly trade policies, interacting with this, especially thinking about the push towards protectionism?
Right. That's the other side of the coin. The strategy, particularly intensified under the Trump administration's second term, has been high tariffs on semiconductors, pharmaceuticals, you name it.
The idea being protect American jobs, bring manufacturing back, reduce reliance on places like China. Sounds logical on paper.
It does. The rhetoric is about strengthening America from within, but the economic reality is often more complex, isn't it?
Always.
Right.
So what are the, let's say, unintended consequences we're seeing?
Well, first, those tariffs. They've significantly increased costs for American companies that still rely on global parts and materials. It's unavoidable for many.
Which feeds inflation, right?
Yeah.
Making things more expensive for consumers.
Directly. It's a key factor in the persistent inflation we've been experiencing. And here's another twist. The tariff money collected over $30 billion last month, which is a huge sum. It's not really going to, say, lower taxes or pay down debt.
Where is it going then?
It's largely being plowed back into subsidies. Massive subsidies for industries that are now struggling to adapt to this fractured global market and higher input costs. Kind of robbing Peter to pay Paul.
And who feels this pinch the most? Is it hitting smaller businesses harder?
Definitely. Small and medium-sized enterprises, SMEs, family workshops, local manufacturers, farmers especially, they're caught in a really tough bind.
How so?
They face much higher costs for materials and supplies because of the tariffs and supply chain issues. At the same time, credit is tighter, and their customers are also feeling the pinch from inflation. It's a perfect storm for them.
And farming, you mentioned farmers specifically. Weren't they supposed to be a key group benefiting from these policies?
That was the promise. But reports suggest American agriculture is now almost entirely dependent on government subsidies just to stay afloat. It's become a lifeline, not a booster.
So the subsidies are basically masking a deeper problem rather than fixing it.
That's a fair assessment, yes. It's a short-term patch for a systemic issue stemming from these disrupted, more expensive global connections.
This brings up the issue of trust and, frankly, credibility. There was that White House claim recently, something about $17 trillion in foreign investment pouring into the U.S. in just 8 months. That number sounds astronomical.
It does sound astronomical, and most economists reacted with, let's just say, considerable skepticism. Some called it incredible, in the literal sense, not believable.
So what's the reality check? Are we actually seeing less foreign money coming in?
The actual capital flow data suggests the opposite is happening. Flows into the U.S. seem to be decreasing. You see traditional big buyers of U.S. debt, think Japan, Saudi Arabia, European funds, they're actively reducing their dollar holdings.
Okay, and if fewer people want to buy U.S. bonds, what does that mean practically?
It means the U.S. government has to offer higher interest rates, higher yields to attract buyers for its debt.
Which makes borrowing more expensive.
Exactly. It increases the cost of servicing the national debt. That means more taxpayer money goes just to paying interest, leaving less for everything else. And it saddles future generations, you, your kids, with a bigger burden.
So while the U.S. is dealing with these internal economic pressures, partly self-inflicted through tariffs, other countries aren't just sitting idle, are they?
Not at all. They're actively capitalizing on the situation. Now think about this. China, in particular.
How is China playing this?
China has made moving away from the dollar de-dollarization a central part of its strategy. It's accelerated significantly.
In what ways?
Well, consider this. The Chinese yuan. A decade ago, it was barely used for international trade. Now, it's used in over 50% of China's own cross-border transactions.
50%. That's a staggering change in just 10 years.
It is. It's a major move toward financial independence and reduces the leverage the U.S. dollar system has over their economy.
And other emerging economies, the BRICS nations.
They're following a similar path. Brazil, Russia, India, South Africa. They're increasingly signing trade deals directly with each other, using their own local currencies, bypassing the dollar completely.
The whole landscape is shifting, which brings us to this. Well, it sounds like a pretty radical idea being discussed in U.S. financial circles, revaluing U.S. gold reserves.
Ah, yes, this is where it gets really interesting and potentially controversial.
Explain that. How does that work?
Okay, so the U.S. Treasury officially values its huge gold stockpile using an old, frankly archaic accounting price. It values all that gold at only about $11 billion.
$11 billion. But you just said gold is around $2,300 an ounce. What's the real market value?
Based on current market prices, that same gold is worth well over $1 trillion.
$1 trillion, just sitting there, undervalued on the books.
Precisely. So the radical proposal is, what if the Treasury just updated the books, revalued the gold to its actual market price?
What would the effect of that be? Like a magic wand for the deficit?
It would instantly create massive liquidity on the government's balance sheet. Suddenly, potentially trillions of dollars appear without issuing new debt, without raising taxes. Bank of America crunched some numbers. They estimate it could cover maybe half of the projected fiscal deficit for 2025.
Wow, that sounds almost too good to be true. A neat solution to a massive debt problem. What's the catch?
The catch is the signal it sends. What does it tell the rest of the world if the U.S. suddenly pivots its financial credibility towards gold?
It signals that the U.S. itself doesn't fully trust the long-term value of its own currency, the dollar.
Exactly. It's basically an official admission that maybe the dollar isn't the ultimate safe haven anymore, that gold is. And that could dramatically accelerate the global move away from the dollar that's already happening.
Pouring gasoline on the fire, essentially.
You could put it that way.
Yeah.
And there's another huge geopolitical dimension here, China. Officially, China reports holding around, say, 2,300 tons of gold. But there are persistent rumors, strong whispers in the market, that their actual holdings might be much, much larger, maybe closer to 10,000 tons, held off the official books.
Okay. So if the U.S. revalues its gold...
It instantly makes China's gold reserves vastly more valuable and powerful overnight. Whatever the true amount they hold, a U.S. revaluation legitimizes gold as the core asset and dramatically boosts Beijing's financial standing on the world stage.
So a move designed purely for U.S. domestic fiscal relief could end up massively strengthening its biggest global competitor. That's quite the unintended consequence.
It's a fascinating and, frankly, dangerous potential side effect. The U.S. tries to shore up its own finances, but in doing so, could accelerate the shift of economic power towards China.
Which leaves U.S. policymakers with a monumental choice, doesn't it? A real dilemma.
A historic one. Do they go for the gold revaluation, get that immediate, badly needed fiscal relief, but risk hammering the dollar's global status and boosting China?
Or do they avoid that, stick with the current path, keep issuing more and more expensive debt, and risk maybe an even deeper economic crisis down the line, something potentially worse than 2008?
That seems to be the stark choice they face. And the decisions made, probably in the coming months, aren't just abstract policy. They will likely shape whether the U.S. remains the dominant economic power it's been for nearly a century, or if that era is truly coming to an end.
And connecting it back to everyone listening, families are already squeezed by rising costs, wages not keeping up. So the final question is really for you. What price should be paid? Is short-term stability at home worth risking the dollar's global power? Or is maintaining that global dominance worth more debt and potentially more pain now? It's a profound question for the country's future.